Okay, this is auditing the first lecture of chapter 12, last chapter of the semester. So we will get through this. Is a shorter chapter than some, so I would anticipate 2 to 3 lectures. I'm hoping not to break it into 4, but we'll kind of see how the time goes. But we'll see kind of how it goes as we go along. So, okay, we're talking about auditing long-lived assets. We're talking about PP&E. We're also talking about things like natural resources, depletion, depreciation, accumulated depreciation, everything that goes along with any long-lived assets that I have. And then we also have a little bit about mergers and acquisitions as well. Okay, I'll let you look at the learning objectives on your own. All right, so this is on page 645. We're going to talk about the different activities in the cycle of long-lived assets, including the acquisition, buying in the first place, how I pay for it. And we're going to talk about the relevant assertions. Just like all the rest of them, we have our 5 relevant assertions here, but we're going to look at, okay, what are those 5, just like all the rest of our chapters, the last several at least. How do these 5 assertions, how are they relevant to fixed assets? How do I test these assertions with regard to fixed assets? Where do my controls come in? Where's my inherent risk at? Where's my control risk at? What kind of controls should be in place? All those that have come throughout the last about 4 chapters or so. So we'll talk about those in more detail in the future chapter. So different things that come into account when it comes to long-lived assets. Obviously, things like equipment. It just says equipment here, but we could also be talking about, there could be a lot of different types of assets. You could have multiple accounts. You could have equipment, buildings, you know, land improvements, leasehold improvements, office equipment versus machinery equipment. You know, you could have tons of these. So this is a pretty simplified, you know, showing of it, but it still shows the gist of everything that we're talking about. We're talking about our assets themselves, depreciation, both the expense and the accumulated, if we dispose of it, gains and losses on those disposals, and if we find that something is being valued too highly, potential impairments and impairment losses. Okay. So the first step here is, and that was on page 645, and so now we're on to page 647, is identifying inherent risks. So inherent risks related to fixed assets. One of the issues we want to look at is asset impairment. So normally management does not have an incentive to write down their assets. Generally, they want their assets to be valued as highly as possible, as high as possible. Because it looks better. Okay, they own more things, they have more investment in the business. Sometimes management wants to write down every potential impaired asset to minimize realizable value, although this will cause a one-time reduction to current earnings. It will lead to higher reported earnings in the future. This earnings management technique is called the big bath. So when we look at things like return on investment or return on assets, one of our numbers we use in that calculation is assets. So companies have in the past written down assets to show their value as being lower, so that it looks like they are making more money on less of an investment. But again, that it does result in one bad year, that's a big bath year, and then from the future, in the future, it looks like they're making more money on less assets, when in reality, they've just written down those assets. So we need to, you know, keep an eye out for that when we're auditing the company. So some of the inherent risks that relate to long-lived assets, management's estimates. Okay, we have estimated useful lives, we have estimated residual values, we have a lot of estimates that go on with our depreciation. So it's a large inherent risk. Asset impairment, we kind of just talked about, and asset disposal. Okay, when I actually dispose of it, you know, and if I stop using something but don't sell it, a lot of times that's technically been disposed of. So we got to be careful with that. So making sure that we understand. When it comes to natural resources, it's a lot of times a lot more difficult to identify the resource itself, and the estimates are also harder to do. And once that natural resource is discovered, you know, once we do find it, say looking for oil or some other mineral, once we do find it, how much is there? Also really hard to estimate. And with intangibles, it gets even worse, because you're talking about, there's some things that are not too bad when it comes to like intangibles with a given useful life, with a tangible life like patents and things like that. But if you get into things like copyrights or other goodwill elements like that, it's a lot more difficult to find a valuation. So there's a lot of inherent risk involved in intangible assets, especially those particular intangible assets. Okay, identifying fraud risks is on page 649. The potential fraud schemes that the long-lived assets can have: overvaluing existing assets, okay, showing that you are in a better financial position asset-wise, capital-wise, than what you actually are. Recording fictitious assets, claiming you bought something that you did not, okay. Capitalizing expenses. So easy example of this: repairs and maintenance. If I repair something, it should be expensed. You know, there's exceptions to that if I actually completely overhauled it or extended its useful life or increased its usefulness or value in some way. That's different. But if I'm only fixing it, if I'm only getting the oil changed, or if I'm only replacing, you know, tires, normal repairs and maintenance on a vehicle is a good example. Those should be capitalized. Those should not be, those should be expensed, not capitalized. Some companies, in order to spread the expense over time and make their income statement look better, can look to capitalize those expenses instead of expensing them in the year in which they should be expensed. Not recording the sales of assets and misappropriating the proceeds. Okay, so not recording the fact that I sold it. And most likely we're talking about misappropriating the proceeds. We're talking about making it like it's a sale, like a revenue, versus it being a gain loss on disposal, because they're different and they look different on your financial statements. Inappropriately assigning residual values, okay, estimating too high or too low, either way. Miscalculation of the amortization of intangible assets. Those are several of the fraud risks. This chapter should go quickly because there's a lot of questions that I'm not going to go through in the video since you're not here to answer the questions with me. Identifying control risks is on page 650. Auditor needs to understand the controls that the client has designed and implemented to address risk. Normally, the auditor gains this understanding by performing walkthroughs, inquiries, observations, and reviews of the client's documentation. Again, similar to what we've done in the past, remembering that certain areas are require additional processing, meaning, observation and inquiry, especially inquiry. The lowest level here is the review of a client's documentation, just looking at paperwork. Paperwork can be changed or redone pretty easily this day and age, so that's kind of the lowest level. But performing a full walkthrough and inquiring of the people who are actually responsible for it, they're usually better, stronger methods and tests and controls, and observations also stronger than the review of client documentation at its basis. So the auditor should consider both the entity-wide and the transaction controls for the different assertions. Okay. Internal controls for long-lived assets. Controls are needed to provide reasonable assurance of the existence, okay, that they actually exist, that they actually own it, and that it's actually there, they actually use it, and the valuation of those. Okay, are they valued properly? Book value. Book value, remember, does not just include what the cost was in the first place, although that's a very important element of it. It also includes, how much accumulated depreciation there is, which means the rate at which they're depreciating it needs to be accurate. Typical control activities include budgeting processes. Who's got the right to say you can and can't buy PP&E, property, plant, and equipment, written policies for asset and disposal, limited physical assets or access to assets, periodic comparison of physical assets. I'd also add to this list capitalizing policies, okay, where I don't even think about capitalizing something unless it's over a certain dollar amount. Most companies don't want to mess with, even if it is technically a fixed asset, if it's a small dollar amount, it might not be worth capitalizing in the first place. So, you buy a small inexpensive tablet for the office that's $150. Is it worth depreciating that over the next 5 years or whatever the useful life you consider it to be? It might not be. Should it be? Maybe. But we don't really concern ourselves as auditors with things that are immaterial like that in the first place, hopefully. Controls over natural resources. We talked about those a little bit too. And control over intangible assets. So who's in control of the amortization schedules and useful lives of patents and copyrights and all those other intangibles. This, by the way, is on 652. This, actually, the PowerPoint has the wrong picture on. This is the same picture we looked at before. But on page 653, if you're looking at the book with me while you're going through this, you'll see that this talks about the authorization process, documentation, and what the approval process is over intangible long-lived assets. So this is not the right part here. This is not Exhibit 12.2. This is Exhibit 12.1 again. All right, performing planning and analytical procedures. So on page 654. On our planning process in the first place, we want to look at, and we've done this some in your data analysis problems, we want to look at trends and analysis. We would review and analyze gains and losses. I'm on page 654. Gains and loss on disposal of equipment compared to depreciable lives used by the client for various asset categories with those of the industry. So there shouldn't be a big difference in how the company you're looking at appreciates a vehicle versus how everybody else appreciates a vehicle, unless they use it in a wholly different way. Okay, useful life is exactly what it sounds like. How long do they think they're actually going to get use out of it? Well, so for example, if they're a traveling salesman where they drive, 20, 30, 40,000 miles a year on a vehicle, that vehicle might only last them 3 years, whereas typical company vehicles where they're not traveling salesmen or don't drive 40,000 miles a year, they might get 5, 7 years out of a vehicle. So we would compare, but we also need to know the company well enough to know how they're depreciating and what they're basing their depreciation on in the first place. Comparing the asset and related expense account balances to the current period for similar items for the prior period. Some additional, so we look at, and then, sorry to go back here, we're going to look at these accounts, which ones have heightened risk of misstatement. We're going to perform meaningful planning analytical procedures for long-lived assets, and we must understand the business and the economics of the client business, which is what I was talking about a second ago. These I was just talking about. I kind of skipped ahead of myself, I'm sorry, but this double bottom part I haven't talked about yet. Ratios the auditor should plan to review after developing the independent expectations include the ratio of depreciation expense to total depreciable long-lived tangible assets, and the ratio of repairs and maintenance to total depreciable long-lived tangible assets. And we'll compare those not only to industry, but we can compare them year to year for the individual client as well. And we'll stop this video for now there, and we'll continue with the chapter in the next one.